Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Before we get started, today's video is going to be a shortened, condensed version of what we usually do in our SPX videos. So in this particular video, we're not going to go over all the different aspects of the indicator. We're mainly just going to go over today's trades for this particular session. If you are not familiar with the SPX Daily Key Levels indicator, then look in the description of the video underneath the video on YouTube, and you will see in the description these particular links that go into more details about how the indicator works and the trading strategy. So there's a video overview as well as additional resources with a Google Drive link for descriptions, links to other videos on different topics about the SPX indicator, and then there's also links to longer that are hour to an hour and a half long SPX trading videos that will go into a lot more detail about the indicator and the daily key levels strategy. If you click on this Google Drive link, we'll show you what screen that takes you to. That'll take you to this particular document, which will have links to other specific topics that are covered about certain aspects of utilizing the indicator. Thank you. Hello, in today's video we'll be taking a look at the Tuesday, January 6, 2026 trading session for the CBOE SPX index. We'll be utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the V2.0 version of this indicator, which was released a couple of months ago. This is going to be a condensed version of our usual full-length session videos. Links to the full session walkthroughs and a Google Drive document covering specific indicator topics are included in the video description as was outlined in the preview to this video. Okay, so some of you may already be familiar with how this indicator works, but for those who are not familiar with that and may be seeing our videos for the first time, this indicator works on the TradingView platform only and supports two different SPX symbols. The first symbol is the symbol that you see it on now, which is the SPX CBOE symbol. So on TradingView, you would simply type in under symbol search SPX, and then you look for the SPX symbol under the CBOE exchange. So this is the official SPX index used for trading SPX index options, and this is the official SPX index that everyone follows. The indicator also works on a second SPX symbol, which is the SPX 500 8 cap, which I'll show you now. Okay, so on TradingView, you would type in under symbol search SPX 500, and then you look for SPX 500 under the 8 cap exchange. This you would use the indicator on if you're, instead of trading SPX index options, you're instead trading the SPX through a Forex broker, through an account that you have, or if you are, for example, taking a trading challenge through one of the Forex-based trading challenge companies, such as FTMO, Apex, the 5%ers. There are approximately 60 to 80 such companies, and the way that trading challenges work is that you pay the trading challenge company a fee to take the trading challenge, and then depending on the level of the trading challenge that you're taking, you will have a specific profit level to meet to win the trading challenge, and you have to do that without violating a daily loss limit set by the trading challenge company, as well as a total loss limit on the account set by the trading challenge company. And if you're able to pass the challenge, then they can offer you a funded trading account in which they put up the risk capital, you make your trades, and then you still have a daily loss limit and a total loss limit on the account. But assuming you don't violate either one of those, then you have a profit split, which generally ranges from 80% to 95% in favor of the trader, and then the rest going to the trading challenge company. A third reason why it works on this particular symbol, the SPX 500 cap, is for those who do trade SPX index options and are typically going to use this on the SPX 500, the SPX CBOE index chart, is that by having the indicator on, say, a second chart open, then you can get the levels for the CBOE SPX index 30 minutes before it opens at 9:30 a.m. Eastern Time. The SPX 500 cap trades in the overnight as well as the pre-market, whereas the CBOE SPX index does not trade in the overnight or the pre-market, and it opens at 9:30 a.m. Eastern Time. So if you have a second chart open with this indicator on the SPX 500 cap symbol, then at 9 a.m., as you see here, you will get two different tables on your chart. One is for the SPX 500 cap levels, which are also displayed here on the chart. And then you have the second additional table here for the CBOE SPX key levels for today's session. And then you will be getting those at 9 a.m., 30 minutes before the CBOE SPX open at 9:30 a.m. Eastern New York time. So this allows you to get a jump on the trading session, make some planning, and go through some additional analysis on your own as to possible trade scenarios that you may be entering during the session. So this gives you a distinct advantage in getting the levels 30 minutes earlier. Again, if you want to do that, then you would just simply open up a second chart with the SPX 500 cap symbol, and then at 9:30 a.m. Eastern, then you switch over to the SPX CBOE chart. Okay, so we're going to look at the trades today here in a minute. We're going to look in today's video. We're going to do a comparison of 0DTE options for day trading versus 1DTE options for day trading. So with this particular indicator, it is made for day trading. It's primarily made for day trading SPX index options, and our daily key level strategy using the indicator is primarily for utilizing 0DTE options. However, if you prefer 1DTE options over that, there are some advantages to using 1DTE. You would not want to use anything longer than 1DTE because these are going to be day trades only. They're not swing trades. They're not trades you're holding overnight. So you'll be opening and closing the positions all in the same session. So if you use anything longer than 1DTE, then you're just simply paying for time value that's going to be of no relevance as far as day trading. However, there are some pros and cons of 0DTE versus 1DTE and vice versa. So we'll be looking at how both of those worked out in today's session and going over the pros and cons of 0DTE versus 1DTE. Okay, so with this particular indicator, as I said, at 9:30 a.m. Eastern New York time, you will get the levels on your chart while you're on the CBOE SPX symbol. You'll see the main key level that you're given for the session is the SPX Bull Bear Key Price Level, so that's also known as the BBKPL level, which for today's session is 69.0180. So what this is the important bull bear pivot for the session. So it's giving you the initial bias for the session based on where price is going to open and close at the 9:30 a.m. opening candle, and then as we move throughout the session. So what this generally means is that bullish above this pivot level and bearish below this pivot level. The other main key levels that the indicator gives are the R1 through R6 levels above the bull bear key price level, and the S1 through S6 levels below the bull bear key price level. Now with this particular indicator, you can take bullish or bearish trades off of any of the main key levels. The main key levels in the V2.0 indicator again are the bull bear KPL level, and then the R1 through R6 levels, and then the S1 through S6 levels. These midpoint levels that you see here are serve a couple of other different purposes. They're not for taking trades off of. And then we also have the QL levels, which are provided by the indicator, which have a singular purpose, which we will go over here in a second. As you can see here, we've drilled down to the R2 through S1. Generally speaking, when you are using this indicator at the open, you generally want to move over to your right side of your price axis here, and you want to expand your by dragging the price axis up, where you will be able to drill down and see the levels more clearly, especially including these levels here, which we'll go over with in a second. So when you're starting out the indicator at the session open, you generally don't want to have all of the 6 levels above and 6 levels below visually on your chart. You want to drill down somewhere between R2 and S2, or R3 to S3, or some combination thereof. And then as price action dictates how the session is going, either bullish or bearish, then you can add into your screen by zooming out to see the other levels as price action dictates, either above or below the bull bear key price level. Okay, so these other levels you see here, we have the PMH, which is the pre-market high, the PML, which is the pre-market low, the YDH, which is the previous day's high or yesterday's daily high. So specifically, that is the previous session's RTH session high. The YDC, which is the previous RTH session close, and then the YDL, which is the previous RTH session's low. So these are important key levels as well. They can serve as breakout levels or reversal levels or stall levels, depending on the context of the session and which levels we're looking at. Generally speaking, for there to be a large bullish move, price is not only going to have to start closing and holding above the bull bear KPL level, but it is also going to have to start closing above and holding above the pre-market high level. Conversely, for a significant move to the downside, not only is price going to have to start closing below the bull bear KPL level and holding below it, but also going to have to start closing below the pre-market low and holding below that as well for a large move to the downside. As far as these YDC, YDL, and YDH levels, they are also important in the context of every session. The daily high can also act as either a reversal or stall point or a breakout point, depending on how price action reacts once it gets to that level. They're also important if they are also in confluence with other levels, which can include midpoint levels or the main levels, as you see here. So here we have the PMH level in confluence with the mid BBKPLR1 level. We have the YDC level, which is in confluence with the bull bear key price level. And we have the PML level, which is in confluence with this particular mid BBKPL S1 level. Sometimes you will see these stacked one on top of the other, like in the case of here. and that can also play a significance in the context of a session. If we were starting to go down as opposed to up in this session, this can take on some significance here when they're stacked one on top of each other and very close to each other. And the same thing can be true on the upside as well. If you will see, say, the pre-market high, if that was stacked very close to the YDH level, which in this particular session it is not. Okay, so also you have these midpoint levels and these QL levels. The QL levels have a singular purpose only, and that is for tight stop losses for either bullish or bearish trades, depending on what type of trade you're taking and what level you're taking, what main key level you're taking the trade from. On the startup display, the default display of the indicator is that you will see the QL above and QL below the BBKPL. However, in the user control panel, you can turn on the QL levels above and below each of the main levels. The main levels again are Bull Bear KPL, the R1 through R6, and the S1 through S6. So that is the purpose that the QL levels provide. For example, if you're taking a bullish trade off of the SPX Bull Bear KPL level, the QL level below is the tight stop loss for a bullish trade taken off of that level, whereas conversely, for a bearish trade taken off of the Bull Bear key price level, the tight stop loss is the QL above the BBKPL. These midpoint levels serve several different purposes, one of which is for standard stop loss levels above and below each main key level. So on the default startup display of the indicator, you will see the mid BBKPL1, which is the first midpoint above the Bull Bear KPL. And on a bearish trade, this would be your standard stop loss on a bearish trade taken from the Bull Bear KPL. And conversely, on a bullish trade taken from the Bull Bear KPL, the first midpoint below the mid BBKPL S1 would be your standard stop loss on that trade. You can also turn on the midpoint levels in the user control panel for off of any of the other main key levels, the R1 through R6 or S1 through S6. And if you're taking, for example, a bullish trade off of R1, then your standard stop loss for that bullish trade off of R1 would be the mid BBKPL R1, whereas your tight stop loss for the bullish trade off of R1 would be your QL below R1. For example, if you were taking a bearish trade off of R2, then you would turn on the midpoint level between R2 and R3. That would be your standard stop loss for a bearish trade off of R2. Whereas your tight stop loss, you would turn on the QL above R2, and that would be your tight stop loss if you prefer to use that. Okay, so let's go ahead and get into the trades of the session today, which we will, as I mentioned earlier, we'll be going over two different sets of screenshots. One will be for the 0DTE options, and then we'll go over the 1DTE options with the same trade. Okay, so here we have the trades for this session, and we also have the data boxes for the options that we'll be looking at as far as the entries and what the prices were on the different levels as price moved throughout the session. Here we have the 9:30 a.m. candle marked off here. As you can see, we have the bull bear key price level here, and this candle opened above the bull bear key price level, and most importantly, it closed above the bull bear key price level, and it closed within the acceptable range for taking a bullish trade off of the bull bear KPL level. If you refer back to the preview to this video, there is a Google Drive document in the description of this video, which has links to other videos on specific topics regarding this indicator. And one of those topics is a video on 9:30 a.m. candle opening trades to avoid, and then also what is the acceptable range and what is outside the acceptable range for the opening 9:30 a.m. candle on either closing above or below the bull bear key price level. So I invite you to take a look at that Google Drive link and go down to that video if you would like more information on that topic, as that video explains. And there's also a accompanying PDF document which also explains further details about what constitutes the acceptable range and what is outside the acceptable range. And that acceptable range also applies to taking bullish or bearish trades off of any of the other main key levels as well, the R1 through R6 or S1 through S6 levels as well. So this particular candle is within the acceptable range for a bullish trade off of the bull bear KPL. So as we have in our note here, 9:30 a.m. opening candle closes above the bull bear KPL 6901.80, and the close of the candle is still within the acceptable range for a BBKPL level based bullish trade. So that is a bullish entry on the BBKPL level on the 9:30 a.m. opening candle. As you can see here, we're on a 2-minute chart. The recommended chart time frames for this indicator for this particular daily key levels strategy is between 1 minute and 5-minute chart time frames, with the most consistently performing chart time frame between that range being the 2-minute. If you look on our other SPX session videos, you will see that we're always using the 2-minute chart time frame. However, if you may want to use this indicator along with other indicators that you like to use to give you additional confirmations. And if that is the case, if you prefer a different time frame than the 2 minutes, such as the 1 minute or 5 minute, that's fine as well. But just note that the 2-minute time frame is the recommended one between the range of the 1 minute to 5 minute, which you would use for this particular daily key levels trading strategy. Okay, so here, as you can see here, these candles here also closed above the bull bear key price level. The 9:30 a.m. opening candle is part of the daily key level strategy. However, it's not mandatory to take the 9:30 a.m. opening candle. You can also wait if you prefer to see what happens in the succeeding candles if you prefer. There's also no obligation to take the initial trades as well if you're the kind of trader who would like to see how the opening range plays out, and then you prefer to take trades off of other levels depending on how price action proceeds in the given session. You can certainly wait to a later time in the session and take a bullish or bearish trade off of one of the other main key levels, either the R1 through R6 or S1 through S6, or you can also wait for an additional play off of the bull bear key price level, which does happen oftentimes in sessions as well, where you can get not only a play off the initial part of the session, but also later in the session, depending on the volatility that we have in a given session. Now, as we noted here, if you did not enter the 9:30 a.m. candle close, then the succeeding candles 9:32 a.m. through 9:42 a.m., so basically the next 5 candles here, also provided opportunities for entering on this bullish trade as well. And if you did wait, you actually, in this case, got a better price on these because they did drift down lower, but still closing above the bull bear key price level. So as we noted here, during the 9:32 to 9:42 a.m. candle closes, we've put the range of the ask prices on the closes of each of these candles as far as the range. So here we have the ask prices on the 9:30 a.m. candle close on the 2-minute chart. So this is 9:30 a.m. closing at 9:32 a.m. But nevertheless, here was the range. On the other ones, which you would have gotten better prices, just giving you an idea of what that would look like if you did not get on the 9:30 a.m. opening candle close. Now, what about strike prices to use? With this indicator, there are always going to be 3 different strikes that you can use for either a bullish or bearish trade off of any of the main key levels. Again, the bull bear key price level, or the R1 through R6 or S1 through S6 levels. So it's a pretty simple process as far as determining what 3 strikes are your alternatives for any trade. We'll go over what they are in this particular trade, but they would also apply the same to other trades as we'll go over. Okay, so the standard play in the daily key level strategy is to use an at-the-money option. The at-the-money meaning the at-the-money strike closest to the level that you're taking the bullish or bearish trade from. In this case, this is a bullish trade. We're taking off the bull bear key price level, and the price of the bull bear KPL today is 6901.80. So the closest strike to that is going to be the 6900 strike. SPX index options, if you're not familiar with the strike increments on those, they trade in $5 strike increments. So for example, 68.90, 68.95, 6900, 6905, 6910, etc. So that's going, the 6900 strike is going to be the closest. We'll be using a call option since we have a bullish entry. The ask price on the 9:30 a.m. candle close is $17, and those are seen here. 9:30 a.m. ask, close $17. You're waiting for the close of the candle to make sure that it is closing above and is still within the acceptable range. So you're not going to enter intra-candle. You can set it up so you can enter at the close or very near the close if it's obvious that it's nearing the close of the candle and it's going to close above within the acceptable range. If you got in on any of these other candles, you're doing the same thing. You're waiting for the close of one of these candles to make sure that it is indeed going to close above the bull bear key price level and that it is within the acceptable range as well. Now, what are the other 2 option strikes that you can use for this particular trade? Well, to figure that out, then all you do is you take the level you're taking the trade from, the direction you're taking the trade from, which in this case is up. So we're going to look up. We go to the first midpoint level above the level we're taking the trade from on this bullish trade, and that is this level, the mid BBKPLR1, 6908.33. So in the 6908.33, the 6910 is the closest strike to that. So that would be your second alternative here. Your first alternative. Then the second alternative would be the furthest out of the money strike you can consider. You would simply look one level up in the direction that you're trading from the trade level that you're taking the trade from. So in this case, that's the R1, 6914.86. So the closest strike to that is going to be the 6915. The ask price on the 6910 is 1060 on the candle close. The ask price on the 9:30 a.m. candle close for the furthest out of the money 6915 is $8. And as we noted here, if you did not get in on this candle and instead for whatever reason waited, you still could have gotten in on these candles here. And then as you can see here, depending on which strike you were looking at, then you would have gotten better prices in that case. That's not always going to happen. Sometimes it's going to be where price just continues to move up. and then price would be moving out of range eventually for a BBKPL trade, and then you'd have to reassess and decide whether you would want to take a bullish trade off of R1 once it gets outside the acceptable range for taking a trade off the bull bear key price level. Again, you can reference that video I talked about earlier that is in that Google Drive document in the description of this video. Once you click on that link, you'll see links to other videos, including the video on that, which goes over the acceptable range and outside the acceptable range. Okay, so what about stop losses? So with this indicator, your initial stop loss is going to be level based. If you do any adjustments to your stop loss later, once the trade is moving in your direction, depending on the type of trade you're doing, once it meets a certain minimum profit threshold, as far as hitting a minimum threshold level in your favor, and if you're going to be adjusting your stop loss at that point, then you would change from a level-based stop loss to a price-based stop loss, as we will go over here in a second. So as far as the initial stop loss, as I said, your initial stop loss is going to be based on a level. So in this case, we had a bullish trade off the bull bear KPL level. The QL level below is your tight stop loss if you prefer to use a tight stop loss. And the standard stop loss is going to be the first midpoint level below the level you're taking the bullish trade from, in this case the bull bear KPL. So that is this level here. Now there are two different types of trades that you can take with this particular indicator. One is a scalp only trade, and the other is what we call a regular trade under this daily key level strategy. So there are some differences between the two different types of trades. A scalp only trade, you're looking for a one level move in your favor for a scalp only, and then you are exiting your trade. You're not doing any adjustments to your stop loss, and you're not doing any scaling out. You're simply exiting 100% of your option positions, whether you're trading one contract, two contracts, three contracts, 5, 10, 20, etc. On a scalp only, you are exiting once it hits the one level move in your favor. So what do we mean by one level move in our favor? That is calculated by simply taking the level you're taking the trade off of, in this case the bull bear KPL. The direction of the trade is up since this is a bullish trade, and then one full level above that is the R1 level. So as you can see here at 946, we hit R1, so that is your one level minimum required move for a scalp only trade. And here are your 0DTE bid prices, which are shown over here on the candle close. The 6900 call is $19.70. So that's a profit of $270 per contract. The 6910 is $12.40. Bid on the close of the candle, that's a profit of $180 per contract. The 6915 is $920, so that's a profit of $120 per contract. Obviously, if you got in on one of these other candles here at a lower price, then your profit per contract would be greater based on what price within this range that you got into. These are all based on getting in on the 9:30 a.m. candle, whereas if you got in on these other candles, like I said, then your profit on each one would have been greater. Okay, so what about a regular trade? A regular trade differs from a scalp only in that it requires a minimum 1.5 level move threshold in your favor in order to have the following options at your disposal on a regular trade. So in a regular trade, you have several different options. One is you can go ahead, just like in a scalp, and close out 100% of your contracts. The second option is that on all of your contracts, you can adjust the stop loss to break even, or break even plus a 10 to 15% initial profit buffer. So what that means at that point, as we said, when you are initiating your trade, your initial stop loss is based on the level. However, if you're doing an adjustment to your stop loss on a regular trade, then you are using a price-based stop loss. So you're switching to price-based. Break even would be the price you paid for the option, or break even plus an initial 10 to 15% profit buffer would be adding 10 to 15% of what you paid to the stop loss. So for example, if you paid $17, $17 would be your break even. That's what you would be moving your stop loss to. Or break even plus 10% profit buffer, you'd add $1.70. That would make it $18.70. Or you could simply round it up to $19. Now, the price on the candle close here are seen on the 0DTEs. But before that, we'll go over the one last option that you have for on a regular trade once it meets the 1.5 level minimum required move. Again, 1.5 level move, you're calculating from the level you're taking the trade from. You're looking in the direction of the trade, so that would be up on a bullish trade. That's the one level scalp level here, one level move, and then the midpoint level here is your 1.5 level move. Now, just for clarity and context, if let's say you were taking a trade, a bullish trade off of R1 later in the session, then your one level move on a scalp would be R1 to the R2 level, and then your 1.5 level move would be the mid R2, R3 level, because that would be the next half level up from this one level move from the level you're taking the trade from here. And it works the same in the opposite direction. If you were taking a scalp trade, a bearish scalp trade on the R2 level, then your one level scalp would be exiting when it hits the R1 level, because your trade was initiated based from the R2 level and it was a bearish trade. And then your 1.5 level threshold for a bearish trade off of R2 for a regular trade would be 1.5 levels, which would be this level here. Okay, so here we have the 9:50 a.m. candle that hits the mid R1, R2. As you can see, it also hit the YDH level. The YDH levels and these other levels here can also be waypoints for decisions on regular trades as well. However, they have to occur after the 1.5 level move in your favor. In this particular case, the YDH level is before the 1.5 level threshold. So in this case, the YDH level would not be an additional waypoint for decision making on a regular trade. If the YDH level was above the 1.5 level move threshold, then it would become an additional waypoint, at which point that would be another decision point for either exiting or adjusting your stop loss, or doing the scaling out as we talked about before. And then the next one would be the R2 level. Okay, so the 6900 call, 2450, that's a profit of $750 per contract. The 6910, the bid on the candle close, 9:50 a.m. candle close, 1630, profit of $570 per contract. 6915 call, 1270 on the bid on the close of the candle, profit $470 per contract. Now here on the 10:02 a.m. Candle, it hits R2. That is the two-level ideal move for a regular trade. What we mean by ideal move versus minimum required move is that Generally on 80 to 85% of the sessions that you will see in a given year, in say a normal year, the low to moderate or standard volatility sessions are going to comprise in a normal year um, about 80 to 85% of your sessions. And in those, the 1.5 level move or 2 level move is going to be the extent of most of the trades that you'll see in 80 to 85% of the sessions, with the 2 level move being the ideal move for low to medium or moderate volatility. Versus higher volatility sessions, then you will see more of a 3 level move or 3.5 level moves, and then in extreme volatility, you will see 4 to 6 or even above 6 level moves. And examples of extreme volatility would be, say, the COVID pandemic, uh, which we had several weeks of extreme volatility during that time. Also, during market meltdowns, such as the 2007-2008 period of time, we did have the real estate crash, and we also had a market meltdown during that time in which we had sustained longer periods of extreme volatility. So in those types of situations, you're going to see more of the moves above 3 levels and a lot of moves that will be 4 to 6 levels. Now with this particular indicator, there are going to be some times where you're going to see moves above 6 levels. And with the V2.0 indicator, it also has levels 7 through 10, which you can enable in your user control panel should we enter into some sort of catastrophic news event or some sort of news event to the upside, which takes us above 6 levels, or in the case of catastrophic, below 6 levels, then you can simply turn on uh, S7 through S10 or R7 through R10. However, those don't happen that often. However, when they do happen, you can utilize those levels with the V2.0 indicator as well. But going back to the main point here, on 80 to 85% of your sessions in, say, a normal year, a 2 level move is going to be, generally speaking, the furthest extent of most moves that you will see in 80 to 85% of the sessions. So what that means is bull bear key price level up 1.5 to 2 levels, or down 1.5 to 2 levels, or in the case of other particular trades, a it could be an R1 down to S1 as far as a bearish trade, or an S1 up to R1 for a bullish trade, or an R2 back down to the bull bear key price level, or an S2 back up to the bull bear key price level. So generally speaking, 1.5 level to 2 level moves. Okay, so at 10:02 a.m., the candle hits R2. So on a regular trade, 2 level ideal move for regular trade. So here we have the bid prices on the close on the 10:02 a.m. candle. $30.30 on the 6,900. That's a profit of $1,330 per contract on that. 69.10, 21.30, profit of $1,070 per contract on that. 69.15, call $17.20, profit $920 on that. Again, these are all based on entering on the 9:30 a.m. opening candle. If you got in on one of the succeeding candles instead of getting in on the 9:30 a.m. candle, then these profits for all of these would have been higher based on your lower entry cost within this range here. All right, so now we'll take a look at the 1DTE options. Okay, so here's the 1DTE options comparison. It's basically the same exact trade setup, except we're going to look at 1DTE and how these pan out versus the 0DTE. Now, one of the things that are an advantage of the 1DTE options is over the 0DTE is that if you're holding a trade into the latter part of the session, and by the latter part of the session, I mean holding it, say, after lunch, after 1 p.m., going into the 1 p.m. to 4 p.m. close. The 0DTEs will begin to have some rapid time decay on them, especially accelerating once we get past 2 p.m. into the 4 p.m. close, versus the 1DTEs, which will still have relatively consistent time value still left in them since they expire the following day. So the advantage of the 1DTE is that if you're the type of trader who likes to hold later on in the session from the beginning of the session, generally speaking, then you're not going to be facing that time decay problem that you could possibly have in the latter part of the session. Should price start also moving against you, you will have two things to contend with, both the time decay and price moving against you. Versus the 0DTEs, you will have both of those working against you, versus the 1DTE, not so much the time decay problem as opposed to just the price moving against you. So conversely, if price still is moving in your favor, the 0DTEs, if price is moving in your favor, you'll get a little more bang for your buck with the 0DTEs. If price is holding and continuing to move in your favor later on in the session, as far as cost versus outcome. So it really just comes down to practicing with the indicator, practicing with both types of options, 1DTE versus 0DTE, and the type of trader that you are is whether you prefer holding till later in the session or not. So that just comes from utilizing it. It's probably best to figure that out for yourself on a demo account versus a real money account, so you can determine which of those two options, either using 1DTEs or 0DTEs, excuse me, work better for you and your trading process. Okay, so as we can see here, it's basically the exact same setup, the exact same strikes. We're just simply using 1DTE versus 0DTE. As you can see here on the at the money standard play, our entry price here in the 9:30 a.m. candle 23.90 versus the 0DTE, we had $17. The price on the 69.10 is $17.70 versus the price on the 0DTE was $10.60. And on the furthest out of the money, the 69.15 is $14.90 versus the 0DTE was $8. Then on these ranges here, if you got in on one of the succeeding candles that we talked about from 932 to 942, if you happen to miss this or made a decision not to take this and to see what happened, then the range here on the 6900 was 2090 to 2350 versus the range on the 0DTE was 1370 to 1660. 6910, the range on the 1DTE is $15 to 1730 versus the range on the 0DTE is 780 to 1020. And then the 6915, the range was 1250 to 1450 versus the range on the 0DTEs was 560 to 750. Now, as far as how they panned out later in the session, here on the scalp only, we had a profit of $260 on the the standard play at the money versus 270 on the 0DTEs. The 69.10, we have a profit of $200 here versus on the 0DTEs, it was actually less, it was $180. On 69.15s, we have 1660 profit, 170 per contract versus the 0DTEs was only 120 per contract. Now on the minimum 1.5 level move, here we have a profit of 640 based on this 30/30 price. And on the 0DTEs, it was 750. On the 69.10, profit 550 per contract versus the 0DTEs were 570 per contract. Then the 69.15s, 1990 profit $500 per contract. Remember, these are all based on the 9:30 a.m. Candle close entry. If you got in on one of these other ones, then obviously, just like with the 0DTEs, then the profit would be greater on all of these. So profit 500 on the 69.15s on the 1DTEs. The 0DTE was 470. Then the 10:02 a.m. R2 hit for the two-level ideal move. 1DTE 6,935.40. Profit $1,150 per contract. On the 0DTEs, the profit was $1,330 per contract. The 69.10s, 2770, profit $1,000 per contract. On the 0DTEs, it was a profit of $1,070 per contract. Then the 69.15s, $24 profit, $910 per contract. On the 0DTEs, it was $920 per contract. Okay, so that's going to wrap it up for today's video. As we mentioned in the preview to the video, if you do have an interest in purchasing this indicator, in return for you taking your time today for watching this video, you can send us an email at daytradinggps@gmail.com to request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are currently sold on a one payment for lifetime access basis. What that means is you make one payment, then you have access to the indicator for life. Lifetime access also includes any future updates or any future versions of the indicator as well at no additional charge. We are going to be coming out with a new version of this indicator, the V3.0 version, very soon. And when that V3.0 version is released, the price of the indicator will be going up substantially from what it is now. So this is your opportunity now to go ahead and get lifetime access to the indicator, and you will get it at the current price, and then you'll be able to apply the discount promo code to the current lower price. And then when the V3.0 version is released, you will also be able to get that indicator at no additional charge. If you like the video, please go ahead and hit the like button, as that helps us with the YouTube algorithm, so we'd appreciate that. And also, if you'd like to be notified when we post new videos on either the SPX Daily Key Levels indicator or any of our other daily key levels indicators for stocks, ETFs, Forex, cryptocurrencies, futures, and also the NASDAQ NDX index, you can be notified when we post videos on those as well. Okay, so thank you again for taking the time out of your day to watch this video. We appreciate it very much, and we wish you much prosperity in all your future trading endeavors. Thank you.